All right, deferred taxes. I was mentioning this. I know you were looking forward to it. Let's go through it. I've given a couple insights into it, but now we're really going to make sure you understand it if you didn't already. Now, deferred taxes emerge when income tax expense, this is what you calculate on your tax return, differs from your income tax liability. This is generally think about liabilities on your balance sheet. Who decides tax expense and income tax liability? Well, tax expense, that's decided under GAAP from FASB, and the income tax liability, that's decided under the IRC from the IRS. So this is what is on your balance sheet as well as what you owe. This is what you are recording on your income statement. It's as well as what you should be paying, essentially. Now, are differences temporary or permanent? We kind of talked about that quite a bit. Here we see that we've got just another little chart, kind of great way to think about something. So if the transaction is revenue or a gain, when it's recorded in the books earlier than the tax return, it's recorded on the tax return later, that's going to create a liability. I would memorize this. This is more prevalent on the financial exam, but this will also be helpful for this exam as well. So let's say we had $10,000 that we recorded for whatever reason. It was recorded on the books right now, but we don't record it on the tax return. We'll record it later. That's going to create a liability. And why is that? And this liability is going to go on your balance sheet as a deferred tax liability. This would be a deferred tax asset. Well, because you do on your financial statements calculate what your tax should be based on your financials, based on the numbers on your financial statements. So let's say it's just $10,000 times 15%, right? This amount would get recorded as tax owed on your financial statements, but there's $0 in tax for this particular transaction recorded for tax purposes. So there's nothing here. As such, you are going to actually owe this later for tax purposes. And that's why we record it as a liability. Because what you're trying to represent, you're trying to balance it out, kind of, if you think about it. Because while we're recording an extra expense on the books, because we're saying we're paying that, right? But we didn't actually pay it, right? We will have to pay it in the future because we have not paid it yet. That's going to create a liability. Similarly, with revenue or gain, let's say it's opposite. So let's say this is now book and this is now tax. So for book purposes, for whatever reason, right now, it's temporary. And this is only for temporary, remember, because permanent can't be earlier or later. There's only temporary here. For book purposes, we didn't recognize this $10,000 now, so we didn't record any tax expense. But for tax purposes, we actually went ahead and paid tax on that because we had to record it for tax purposes. Well, because we actually went ahead and paid it in taxes, we are recording a benefit like an asset on the balance sheet. Kind of think of it like also with goodwill. If you overpay for a company, you can record goodwill. If you underpay, you record a bargain purchase. It's kind of just the result of the difference in what you do. Similarly, expense or loss, same sort of thing there. Extra deductions, same logic applies. Let's keep running through. And I'd say write out your own numbers and try this out. Like I just did there. This is a great way to help yourself understand. That's why I provide so many dang examples for you. But make sure you're really running through and practicing this. Whenever you see something and you're questioning it, write out your own numbers, just like I did here. That'll be helpful in the exam as well. If you are stuck and your mind is numb, if you write out numbers, placeholder numbers, it can really help you overcome some challenges. All right, talking more about these deferred taxes. This is, like I said, it's more important on the financial exam, but this very much helps us to understand everything we've been seeing so far in this lesson. Deferred tax liabilities and assets, these are accounting concepts that do arise from these temporary differences. Deferred tax liability, it's a future tax payment that a company will owe to the government because of a difference between the tax basis and book value of an asset or liability. This happens when the tax basis of an asset is lower than its book value, resulting in lower tax payments in the short term, but higher tax payments in the future. This is just talking about what we just saw in the prior slide as well. Deferred tax asset is a future tax benefit we expect to receive because of a difference, the temporary difference. This happens when the tax basis of an asset is higher than its book value, resulting in higher tax payments in the short term. So we're paying more upfront, but we're going to pay lower taxes in the future. So we're recording it as an asset because it's kind of like it's like a prepaid. I mean, it's not at all, but think of it like a prepaid. We prepaid our taxes, paid them now. We don't have to worry about it later. The concept here is just dealing with, again, the basis of an asset change, dealing with depreciation, dealing with all of those other differences. Now, you're generally, as a company, always going to have either a deferred tax asset or liability in your balance sheet, and it could change year to year. It just depends on these calculations. Now, for example, if a company buys an asset for $100 and depreciates it over time for accounting purposes, but the tax code allows for faster depreciation, resulting in a tax basis of $80, the resulting $20 difference would create a deferred tax liability. This means that the company will have to pay additional taxes in the future when the asset is sold due to the lower tax basis. Now, in summary here, these are going to result from temporary differences. I think we've beaten that to death. Here is a great slide. I would definitely just memorize. It's wonderful to know. When the tax income is less than financial statement or book income, that's going to create a liability. And let's just think about that for a second. Why? Well, because it's like we've just done a million times. If we've got an extra $10,000 of financial statement income, we pay tax on that now, or we didn't actually pay tax on it, right? Because we said we pay tax on the financials, but we didn't actually. We didn't pay tax on that. We're going to have a liability. We're pushing that tax out into the future. If we have higher taxable income now, we pay tax on it now, but we don't record that for the books. We are getting an asset. We're paying the tax now, not recording it in the books now. We will get a benefit later. But when taxable income is less than the book income, we have a deferred tax liability. You can memorize it. You can rationalize it like I did here. I would suggest a nice combination of both. Just take a look, take a read. I feel like I'm beating it to death now, but hey, there's never too much learning, repetition, memorization, all that good stuff. All right, we got a little bit more in terms of examples, then a recap, and we'll call it a day with a nice summary. Now, at the end of year one, the corporate tax rate is changed from 40% to 35%. The new rate is effective January 1, year three. The deferred tax account is as follows. We've got excess tax depreciation and a deferred tax liability of $2.7 million. Related taxable amounts are expected to occur equally over years 2, 3, and 4. What's the journal entry reflected for the change? Let's take a look here. And the reason I'm also kind of going through this a little bit fast is this is very much, like if I was saying before, this is financial accounting related, this is very much financial accounting related. This is not really dealing with the exam here. This is just more for your understanding. But don't worry, we are almost done. It's like if you wanted to understand this a little bit further, how it works, because it's very helpful to understand how the books work, to understand how book to tax works, because it starts with the books, all that. So future tax, here's the change, right? Future tax, well, 40% is the amount for year two, but it changed year three. So we apply the 35% rate. So we see that our deferred tax liability changes 800. Now it's only 700 for those following years. Like I said, I blew through this example on purpose. It's not too important, not really important at all. You're not going to see a question like this on the exam. Just something you were knowledgeable in the area and you wanted to keep going further, a little extra credits, bonus points. Recap here, just make sure you know these temporary differences, permanent differences, good examples of each of those, and then understand the schedules M1 and M3 primarily. Just make sure you're familiar with those, you kind of know what they are. Take a look at the tax forms. I always do recommend doing that. It's a great way to make it a little bit more real in your mind. That's about it for the day. Let's wrap it up with a nice summary and send you on your way. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.